Hey everyone, welcome back to the channel. Hope you had a very Merry Christmas for those of you who celebrate. This is another episode of my Magic Formula portfolio series where I'm running a test portfolio using the Magic Formula strategy as made famous by Joel Greenblatt in his book, The Little Book That Beats the Market. Now last month we did not have an episode, however I'm going to be getting back to doing monthly updates for this Magic Formula series, and also because I want to start adding some new sorts of elements to this series, not only looking at just Magic Formula, but maybe some of its close cousins, like the Acquirer's Multiple portfolio, which I'll get to later on in this episode, and just having some sort of different benchmarks to compare this portfolio to. The whole point of this series is to explore different options for value investing or things that theoretically would beat the market long term. And one of the tricky things about testing strategies is it's always past looking. You're looking at how the thing has done in the past. That's no guarantee that it's going to do the same thing in the future, especially when we're looking at data from a very long ago. Who knows if something has changed or if people have identified this as a viable strategy and so many people pour into it, all of a sudden it's no longer a viable strategy for beating the market. So there's all sorts of different things that could happen. So having more up-to-date data is important, at least in my view, but you can do whatever you want with this. It's not financial advice. I'm not suggesting you do this portfolio. This is just a really experiment and I want to share the results. Let's go ahead and take a look at how the portfolio is done, at least over the past 2 months since we had our last episode. The portfolio is still down. Remember, this is a little bit awkward since I was churning through holdings and was adding new money into the portfolio. I'm still adding cash to the portfolio. You can see it here in my cash balance, but I'm not actually investing it into any holdings at the moment because I want to decide how I want to go forward in the future, whether I want to have kind of secondary portfolios alongside this, not just going directly into Magic Formula, but maybe having Acquirer's Multiple. I'm getting ahead of myself, but things are still generally down. They are up from their lowest lows of the past few weeks, since December was pretty rough, especially for a lot of smaller cap companies and really just a lot of companies in general, with the new variants and also with the fears of inflation and potentially the Fed tapering and all these terrible things for the market. It was a pretty rocky ride in December. And if we head on over to my spreadsheet, which I include linked in the description below if you want to take a look at it for yourself, you can see all the major holdings here and the general sort of industries that they're in. And you can see it's very heavily skewed towards pharma stocks, which I've talked about at length over the past few months in doing this portfolio. But anyways, if we go down to September, this was the last time I made any significant updates or any updates in general to the portfolio. And we can see the gain or loss in this J column right here compared to the September 27th, 2021 share price, which is when I decided to lock in the 1 year hold strategy rather than doing the monthly churning I was doing in adding and dropping off holdings to the portfolio every single month. And if we scroll on down to the bottom, we can see that on average, this doesn't include dividends. This is a very crude sort of way to look at it. We're down 5% over the past 2 months. And if we go all the way back to March, I kind of had that control group right here. If I had just bought all these holdings in March that were on the list, some of which are no longer on the list, and there are holdings that are not included that are now on the list. But anyways, if I had just held all of these way back in March, we could see that the return would be a negative 3%, not including dividends. So it'd probably be closer to, I'll just say around 0%, would be pretty flat. And that's definitely not good compared to the market, but it is still a pretty small sample size. We're looking at about 3/4 of a year, which I guess is significant, but for a long-term investing strategy where you're theoretically doing this for years, it's not a whole lot of data, but I guess you could say the same thing about the index, right? Looking at year-to-year stats isn't all that helpful for a long-term investor, but I'm trying to collect as much data as I can. I don't want to overanalyze these things yet, but it's pretty clear that value in general is lagging behind. In either case, when we look at both the last 2 months or since March of 2021, the performance has not been good, especially compared to the broader market. And that seems to be pretty consistent with what I've heard about people who are using the Magic Formula, at least the kind of more traditional version where you're following this sort of index that the Magic Formula site creates. And it generally hasn't done as well as a broad index, something like an S&P 500 index fund. It has not done as well as those things in recent years. But we'll see what happens, especially if we get any sort of market crash, a significant one, any sort of reset in the stock market, and not just something that is kind of patched up by insane monetary policy and lots of government spending like we saw in the last year, or really last 2 years with 2020 and into 2021. We'll see what happens. There's no telling what's going to happen in the near future, but I would think that if you had a significant reset in the stock market, you'd probably expect growthier stocks to be really heavily punished, and you'd see maybe value stocks with higher earnings do a lot better as we would correct towards a fundamental trend line, the one that value investors seek so diligently. They're looking for companies to reach their true intrinsic value that the market might not be seeing. Because ultimately, value investing is a contrarian strategy. You're looking for companies that you think the market is wrong about in a big way, usually, at least if you're going off the more traditional sort of Buffett take on it, where you're trying to get a really good price on a good business, or if you take more of a Benjamin Graham approach, an extremely good price on maybe not a so good business, but it's so cheap that it makes it a great deal. But as for the portfolio itself here on M1 Finance, if you guys want to check out this platform here, this brokerage I'm using, it's M1 Finance. It's free to use, and I have an affiliate link in the description. If you use that, that would help the channel out a lot. But in any event, I have some cash in this portfolio. I'm going to keep adding to it. It's an IRA, so it's a retirement account. I get some tax benefits for doing that. I get a write-off on my taxes every year for adding to this account, and I can only add up to $6,000 per year to actually get that write-off. So keep that in mind. It's not as though this is going to magically blow up with some huge cash infusion. There is a limit on it, at least for taxable reasons. But I have some ideas for what I want to do with this cash beyond just adding it to the existing Magic Formula holdings. I kind of want to let these run and see what happens. Meanwhile, I'd open up sort of a side experiment within this same sort of theme of looking for a more passive style of value investing, because that's really how I'd characterize the Magic Formula strategy. I mean, it's kind of in the pitchy sort of name of being a magic thing. You just follow the formula and that's it. It's so easy. It's practically mindless and that's it. So that's kind of the main appeal of something like this. But there are some other similar strategies out there, like the acquirer's multiple, which I've mentioned a couple times already and on other episodes as well. And this is kind of a response to the Magic Formula strategy, and it looks much more closely at earnings yield rather than both earnings yield and return on invested capital like the Magic Formula does. The Magic Formula book was written in an attempt to try and find a way to emulate the sort of Warren Buffett principle of finding a great business at a fair price. The great business would be represented by a high return on invested capital, theoretically, and a fair price, again, theoretically, would be represented by earnings yield. But I've finally gotten around to reading the Acquirer's Multiple book, this one right here. I'm not quite finished with it, but I'm most of the way through, and it challenges the Magic Formula. It looks really specifically at earnings yield, or what it calls the Acquirer's Multiple, in that it's looking at the cheapness of the company, not really paying attention to return on invested capital or that quality metric. And even if that metric is accurate for determining quality, in this case, it might not actually be relevant if we look at past data. And if the past data suggests great results in the future, hey, maybe there's something here. So I do want to finish the book first, and I think I'll do a deeper dive on the Acquirer's Multiple at least in the next month, but I'm heavily considering doing something with adding the Acquirer's Multiple into the Magic Formula series that I'm doing here, kind of as a side experiment and a way to collect even more data on another one of these sort of passive strategies, at least one that seems quite lucrative and quite interesting. And another question is, do I want to use something like the Acquirer's Fund, which is ticker symbol ZIG, ZIG, and that would actually do a lot of this for me in that it's looking for these sort of deep value plays, looking at the cheapness of the company, but I'm not picking any of the stocks myself and I don't have any control over that. Do I want to do that? Or do I want to go to actually pick the stocks that are on the Acquirer's Multiple list in a very similar way to how I'm doing the Magic Formula? I have a feeling there might be a lot of overlap in those holdings, but maybe the few holdings that are different would create a significant difference in performance. But another option would be adding something like one of these value ETFs, these broader indices that a lot of the big brokerages do. So here's one from Vanguard, the Vanguard Value ETF, and it follows this one right here, this CRSP US Large Cap Value Index. So I went ahead and looked at this index, and as promised, it's a lot of large cap companies. And if we look at the top 10 holdings of this index, we can see that it is definitely a lot of larger holdings as they advertise, but it's probably lower PE holdings than you might see in something like the NASDAQ or a more tech-oriented ETF that might have very high multiple companies. And maybe those companies have higher growth potential, but you don't want to overpay for growth. And at the same time, you don't want to overpay for a company that can't grow. So it goes both ways. But either way, it's another sort of passive approach to more value-oriented investing. It does have Berkshire Hathaway in there. It's only 3% of the portfolio, but hey, that's something. So that's another option I might consider adding. I might even add both, something like the Acquirer's Multiple and one of those ETFs focused on on value that's really more like a broad index of the whole market that is maybe skewed a bit towards what you would consider value with lower multiples. But I definitely want to know if you guys have any other ideas on sort of more passive approaches to value investing. Maybe if there's a specific multiple you would look at, or something that's pretty easy to comprehend and that would make sense from a value investor point of view, trying to get good companies or great companies at a discount to their intrinsic value, or at least getting relatively cheap companies compared to the broader market. The whole point of the series is to collect data and see what works. So if you don't want to miss future episodes, be sure to subscribe and hit that bell icon so you don't miss any future notifications as well when I put out new episodes. I have a lot of other content on personal finance and investing, so if you like that sort of stuff, then that's another reason to subscribe to the channel. But thanks for watching either way. Until next time, take care.